Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning. I hope you had a great weekend. Welcome back to Money Talk at the start of the new working week on Monday, the 26th of February. This is Peter Lewis with an update on the latest business stories from across Asia. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, Hong Kong plans to be more focused and effective in using limited public resources while facing a deficit, Financial Secretary Paul Chan wrote in his blog yesterday. That's before announcing the SAR's 2024 budget on Wednesday. Mr. Chan said in his latest post Sunday that the complex geopolitical situation and high interest rates slowed down post-COVID economic growth last year, but the support of the country and connectivity to the rest of the world remain Hong Kong's biggest strengths in building its economy. The Financial Secretary expects Hong Kong's economy to gradually pick up and the business environment to improve this year. Fresh data showed China's new home prices fell the most in 10 months in January, despite multiple efforts from Beijing to revive the property sector. China's new home prices declined by 0.7% year-on-year in January, steeper than a 0.4% fall in the prior month. It was the 7th straight month of declines and the steepest pace since March 2023. The National Bureau of Statistics said 56 of 70 large and medium-sized cities saw month-on-month drops in new home prices, down from 62 in December 2023. Fed Governor Christopher Waller, a voting member of the Interest Rate Setting Federal Open Market Committee, said Friday that data since his last speech on January the 16th has reinforced his view that they need to verify inflation progress and there's no rush to start cutting interest rates. He warned that cutting too soon could undermine the inflation progress and pose considerable harm to the economy. China's stock markets inched higher on Friday. The CSI 300 ended 0.1% firmer at 3,490, extending its winning streak to 9 consecutive days. For the week, it rose 3.7% after markets reopened from the Lunar New Year holiday, and the CSI 300 has now turned positive for the year, but remains down about 40% from a 2021 peak. On today's programme, I'm joined by Alex Wong, Director at Alex KY Wong Asset Management, and David Friedland, Managing Director of Asia Pacific at Interactive Brokers. Providing a view from mainland China will be Yanan, the Chairman and CEO of Surfin Group. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. The Facebook page for any questions or comments is Peter Lewis Money Talk. On X, I'm at Money Talk R3.
Peter Lewis's Money Talk.
On Wall Street, the S&P 500 eked out a new record high on Friday. The benchmark index rose by less than 0.1% to close out the week at 5,089. And earlier Friday, the broad market index broke above 5,100 for the first time, and for the week, it gained 1.7%. The tech-heavy Nasdaq Composite fell 0.33% to 15,997 after notching a fresh 52-week high earlier in the session, and the fall reduced its weekly gain to 1.4%. The Dow added 62 points, or 0.2%, closing at an all-time high of 39,132. Over the holiday-shortened week, it gained 1.3%. Nvidia is on track to become the first semiconductor firm with a $2 trillion valuation. The chipmaker's shares rose 0.4% Friday to close with a $1.97 trillion valuation after briefly topping the $2 trillion mark in intraday trading. 10-year Treasuries rallied, with yields falling 8 basis points to 4.25%. The yield on the 2-year note was down 3 basis points at 4.69%, and the yield curve flattened on the week to its most inverted since 2023. Rate cut expectations for 2024 continue to slide, with Fed funds futures markets now pricing just a 30% chance of 4 cuts and 70% odds of 3 cuts this year, and June is now the favoured month for rate cuts to start. The US dollar index ended the day flat, just below 104. The dollar was unchanged against the yen at 150.5 per dollar. The yuan was unchanged in Shanghai at 7.19.5 renminbi per dollar. Gold closed 0.6% higher at $2,036 an ounce, the highest since the start of the month. And for the week, the precious metal rose 1.1%, the best week of the year so far. Brent crude oil settled at $81.62 a barrel, down 2.5% on the day and 2.2% lower over the week. Hong Kong's Hang Seng Index was 17 points lower, or 0.1% in volatile trading, ending the day at 16,726. And for the week, the city's benchmark index rose 2.4%, and the Hang Seng has risen almost 12% since the benchmark hit a 14-month low in January. The Hang Seng China Enterprises Index climbed 3.7% last week and is close to wiping out its losses for the year. Looks like a flat open for the Hang Seng this morning. Futures markets projecting the index to start the day at 16,720. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Monday morning guests. We have with us Alex Wong, Director at Alex KY Wong Asset Management. Morning to you, Alex.
Hi, morning, Peter.
And also joining us, David Friedland, who is Managing Director of Asia Pacific at Interactive Brokers. Morning to you, David.
Morning, Peter.
So Nvidia's bumper earnings, it drove a global stock market rally last week. We saw the S&P 500, the Dow, the Europe Stock 600, France's CAC 40, Germany's DAX all hit record highs, along with, of course, Japan's Nikkei 225, which closed above 39,000 for the first time ever. Nvidia is on track to become the first semiconductor firm with a $2 trillion valuation. Alex, is that justified?
Yeah, I think this is still justified because the earnings growth is very phenomenal. I think you have to take into account of this social era influence on the stock market. Nvidia probably is the one that everyone in the world is concerning about right now. So buyers actually are from the group, and then everyone actually sitting on it very comfortably. So I think it probably may be a little bit overbought because of this, but I think the momentum actually would be strong. But this would be an exceptional case because Nvidia's story is very unique. So I think we should not be too enthusiastic to find the next Nvidia. I think Nvidia probably would be a very unique case.
It's sort of it's the most important stock in the world at the moment, isn't it, really, in terms of what's driving the markets right now?
Yeah, right. Actually, if you look at Nvidia valuation, it's around 2 trillion. If you compare it with Bitcoin, then I would rather buy Nvidia instead of Bitcoin. So I think that's the logic behind this phenomenon. I think this is the most important stock in the world right now, and it will continue to be so.
I suppose, to be fair to the company, I mean, it had, there was very lofty expectations about how its results were going. And a lot of people were concerned that it just couldn't possibly meet those high expectations. But it not only met it beat them, didn't it? It beat on revenue, it beat on earnings, it beat on its forward guidance for the coming quarter. You really couldn't find almost anything wrong with those results at all.
Yeah, right. I think the key risk is that some a really serious competitor coming out. So that is the thing that would end this the rally. But I think people probably are very comfortable on this tech edge. So that's why it is so supported. And in the meantime, because of the lack of real competitions from others, so I think Nvidia probably may continue to deliver.
Is there any competitor on the horizon that could compete with Nvidia?
If you believe in Nvidia, probably Huawei would be the one.
Okay, well, that would be interesting. David, what do you think about this? I mean, this is an extraordinary stock in many ways, really, isn't it? The world stock markets are depending upon it. I mean, how justified do you think it is?
Well, it justifies it's justified, but it just shows the importance and acceleration of the focus on AI and the demand for the chips. And they just nailed it. They got the chips. They everyone knew this was kind of coming, but developing a chip is so damn difficult, and they just have it. And obviously, AMD and some other companies are going to try as hard as they can to come up with something in the next generation, but I don't see it in the immediate future. It's dominant force.
It's amazing the way the company's changed, isn't it? Because a few years ago, it was known for its graphics cards. That's what you bought NVIDIA for. But it's sort of completely transformed itself into this sort of AI chip manufacturer and really cottoned on to the biggest trend we've seen in markets for a long, long time.
Well, the AI chips were coming, but then prior to that, they really monopolized and they hit the home run with Bitcoin mining. And they had the chip that was fastest and dominant for that. They were a stagnant stock for years. Intel was they kind of worked in parallel. Intel was actually a much stronger stock, and you compare the two, it's phenomenal how the times have flipped.
Is the AI phenomenon, is it justified? I mean, Jensen Huang says AI is at a tipping point now. Do you think he's right?
I think so. At first, you can always be skeptical when new technologies come out. But the reality of what's happening and how it's transforming certain things, we're only at I wouldn't even call it a tipping point. We're at a dawn of a new resurgence of what the possibilities are, good and bad.
Mm. And it's affecting every industry, isn't it? Including yours. It's affecting financial services as well.
Well, of course, you have everything from stock people predicting the stock market to using AI to trading, but also in the client service space, it's going to be transformative, where the amount of information that's available to anyone is going to be at a click of a button, and it's to focus on certain aspects and improve many areas of just even financial reporting, of things you can automate and things that you can do in the industry to make things much more efficient. Of course, there's a lot of risk with that because AI is only as good as, the old computer adage, garbage in, garbage out. You've got to make sure the bots are learning properly.
But are you having to rethink as a firm your business model as a result of AI and the sort of services that you're providing to clients? Is it posing a big challenge?
Well, at this point, I'd call it more of an opportunity than a challenge, because the access and the availability of information that you can put in front of people to make decisions is so much stronger. It's much more available, much easier to obtain. So sure, we have to think about how we implement that into our business. And that's going to be changing rapidly. Just like we went through this before with the internet 20 years ago. I think developed so fast. Let's see what happens here.
Alex, where does the stock price go from here? I mean, it's at an all-time high. It's almost got a $2 trillion valuation. Can it keep on surging like this?
I think that it would still be very well supported. So, and very likely it would continue to be overbought, because I think it's a social media era actually would propel certain stocks to very high levels. So I think that this is the one which we are having it right now. So I think we are likely to see it continue to go higher, but I think we should be cautious in chasing the next NVIDIA or the poor man versions of NVIDIA. I think that is the risk of trading right now.
Is it going to be enough, though, to keep the global market rally going? As I mentioned earlier, we've got new highs now in the US, in Europe, in Japan. Can this rally keep going on the back of almost just one stock or just one phenomenon, the AI phenomenon?
No, I think it would not be able to keep all the things higher, but I think certain concepts actually would emerge. I actually like films relating to stock trading, because I think many people actually would be interested in stocks because of NVIDIA, and probably they would spread out their buyings into other things. And so I think exchanges, brokers, and index providers, actually, they are probably would be okay in the next round. So I think we would see more and more interest coming out from the retail side in the globe because of NVIDIA. So that would be supportive for certain sectors. But I doubt whether this was continue to spread out to the whole market, because interest rate outlook actually is not that favorable.
And is this something that you're seeing signs of, David, because of the interest in NVIDIA and the publicity that NVIDIA is getting? Is it encouraging people to trade stocks overall?
I think so. I think, but it's not just NVIDIA. NVIDIA is, first we had Tesla, where there was massive interest in. You have all the FANG stocks that were gaining interest, and then you have the access of information. So, and then all the news with NVIDIA, which kind of overlaps with the whole Bitcoin and the crypto phase phenomena, where access for new investors is so simple. And I guess it's what people talk about over the water cooler, if they came to work. But these days of work, they talk about it on videos and social media. So yes, there is a whole new class of investors coming into the market. What's really interesting is that not only are they looking at the stocks, the stock options have been growing in particular interest amongst new traders in retail, and they've seen good growth this year as well.
Is some of that fairly speculative, though? I mean, we hear reports about, a lot of interest in things like one-day options, which, expire at the end of the trading day, which are really sort of all-or-nothing bets on the market, aren't they?
Yeah, they call them 0 days, but they are speculative. They're the fastest growing sector in product that's in the option space is growing. But they are used. There's a lot of, with the high interest, there's good plays out there to take advantage of just hedging your stock, getting some instant cash against the options. But they are very speculative and people like them.
Alex, what happens if NVIDIA goes into reverse? Does the whole market rally come to a screeching halt?
May not be. I think if it comes down, then probably we may see a rotation into value at that time. So I think it depends on the reason of the reversal. But of course, it will bring down other tech stocks if it happens.
So what is what's going to take the S&P 500 so sort of 5,100 and above? I mean, it's above 5,000 already now. The Dow's above 39,000. Do we need new leadership to try and get this next leg up, or is this going to be enough, just this current theme?
I think the current theme actually is enough. I think that people are very confident in AI right now, and we are having a solar, and that is boosting the confidence towards the bigger caps. So I think that this is already having enough catalyst. So we are likely to see continuation of this current uptrend. Yeah.
I mean, it's gains. It's about a quarter of the S&P's gains this year. So it's sort of like a pretty top-heavy market at the moment, isn't it? But you don't seem to be too worried about that.
Yeah, I think this is the new phenomenon because right now interest rate outlook is not that favorable, so people are not willing to diversify much into laggards. So we are likely to see the AI beneficiaries to continue to dominate the market for a while until we see some change in the interest rate outlook. Otherwise, I think value probably will still be lag behind.
I mean, what I find astonishing is just how much the market cap of these companies are growing. I mean, the Magnificent Seven big tech stocks, on Thursday, they added over $500 billion in market cap, $514 billion in market cap, just those seven stocks. That's almost the whole of JP Morgan's valuation. I mean, we're in astonishing sort of territory, really, aren't we?
Yeah, we have to consider that Tesla and Apple right now is already out of favor because of its own reason. So someday probably we may see that kind of thing happening to others as well. Actually, Google also is lagging behind now. So I think we need to examine the stories of each individual companies, even though the overall trend is strong. But of course, this is astonishing because I think this is supported by global interest. And actually, if you consider the number of investors in the world and the market cap of NVIDIA, if they concentrate their buying on certain small areas, actually that would be very supportive for them. And then that could create a positive spiral because people bought earlier actually are sitting comfortably. Probably they liquidate some of their holdings and then sit on zero cost. So that is why they are so strong.
David, what are your thoughts? I mean, this is a market that's, going to all-time highs on a smaller and smaller number of stocks. It's not even the Magnificent Seven anymore now, is it? It's a subset of them, but the sort of gains that we're seeing in these companies on a daily basis is just astonishing.
Yeah, I think some of that is the news and how everyone focuses on one or two particular stocks, but the reality is earnings remain strong. And in a high interest rate environment, you think, when's it going to fall apart? And it just doesn't fall apart. The earnings in the U.S. have remained strong this season. I think, I don't know if I had the exact number. I think it was like 70% of the companies were meeting or beating estimates. And we're probably 6 months away to start lowering rates, which could possibly improve earnings even further. So I think things are looking pretty good, especially if they can hit the soft landing in it. And if we go back 2 years ago, we were all talking about a recession. That just didn't happen. And here we are looking at, it's almost like the ship has been guided pretty damn well.
Yeah.
And I don't see things crashing that quickly because the earnings are there supporting pricing.
It's not even a soft landing for the economy, really, is it? It's no landing at all. The economy is just going on pretty well as it was.
Yeah, it's kind of shocking, but the consumer power is strong and the market keeps ticking along. And that's obviously not the case globally, but the U.S. is driving the world in terms of where the capitalization is, where the trading is. Well,
I suppose that's the thing, isn't it? It's the US is the outlier now, isn't it? Because if we look at the economic data from elsewhere, Germany's slipped into recession, the UK is in recession, Japan's in a technical recession, a lot of other economies in the region we're seeing from the GDP data, like Singapore, for example, is slowing. It's almost now that this is not a global phenomenon. It's just the US is the outlier in a world of slowing economic growth.
I guess that's somewhat true, but I guess that those markets are slowing down, but they're still plodding along. They haven't crashed, and I still, as the U.S. does falter at some point, that money will probably flow into the other sectors. But right now, it's you put your money where the strength is.
Alex, of course, we shouldn't forget, it's almost been overlooked in the excitement about NVIDIA, but we did get the Fed's minutes of its last meeting earlier in the month, and it was clear from those minutes that the Fed is not ready to start cutting rates yet, is it? And probably not at the earliest until June, if you listen to what Fed Governor Christopher Waller was saying on Friday.
Yeah, I think popular market is already expecting a cut not earlier than June already, but that is not affecting too much. I think the bond market actually reflect more on the interest rate outlook right now because this year we have a strong divergence between stock and bonds. Bonds actually remain under pressure for quite some time, but the stock market continues to be supported by AI. So I think the market actually is already discounting that the rate cut would be delayed, and the magnitude of the cut this year actually would be smaller than expected earlier. This I think would be discounted already, but of course we probably may continue to look at data because. Inflation data actually are more stickier than we expected. So that probably may still be the concern right now.
It does look like that the market is coming more in line with what the Fed was thinking. We seem to be, at one stage, we're at 6 rate cuts this year. The market now is pricing in around 3 rate cuts. But I'm wondering if the Fed is going to move away from that. I mean, that's what the last dot plot said. But maybe the Fed, do you think it's maybe it's starting to revise down its own forecast to maybe just 2 or 1 rate cuts this year?
Yeah, I think that is a chance because if you look at the data right now, job market remain resilient, and then the inflation actually is worrisome. I think we actually expect inflation to slow down much more faster, but the latest facts actually are much stickier than we thought. So I think that is the key to watch right now because we probably will need to see inflation to cool down before we see rate cuts.
Is there a chance that rates could go up? We've had that balloon floated by Larry Summers last week, who said, there is a chance that the next rate move could be higher rather than lower. We saw the Australian Central Bank, they debated at their last meeting whether to actually raise rates. The Reserve Bank of New Zealand's being rather hawkish at the moment as well. Could we be getting this wrong, and maybe, we're not going to see rate cuts, we may have to see further hikes?
That depends a lot on inflation, but I'm optimistic that the inflation actually would not be getting much higher. So I think we are unlikely to see rate hike, but the timing of inflation of rate cut actually would probably much more later than the market expected. That is a risk. David,
what are your thoughts on that?
I think, yeah, the Fed is doing their best to not be political. At least they say so. And if you have if they raise rates during an election year, that becomes political. So I think they'll try to avoid that as best they can. But of course, inflation is the key here, and it seems to be under control.
Although Donald Trump would say if they cut rates this year, that will be political as well.
He would say he'd be credited for that. And he's the reason. He would say he'd take credit for going up or down, either way. But they've been forecasting, and they've been saying the rate cuts are coming, and that's factored into the market. So it doesn't matter what he says or doesn't, because it's what the market thinks, and I think it's anticipated. So I think staying the course and keeping as they are is essentially the same as rate increases, because everyone's been factoring the cuts.
But from the Fed's perspective, I suppose that if it's truly a data dependent Fed, it couldn't possibly conceive of cutting rates at the moment, could it, based on the data that we're seeing?
Well, you see the January data where, if you're going to raise prices, quite often happens in January. So we have to see what happens to the inflation with the price, the next inflation data coming out in February and March. But also job creation was incredibly strong in January. We'll see if that continues. And that will be the driving factors.
It does look like, doesn't it, that inflation has got rather sticky if we look at the last few months' data. It seems to be stuck around 3%. So there's not much sign at the moment of it coming down to 2%.
I don't think so. And there's still, with the job market so strong, there's still pressure on wage inflation as well. So it probably is sticky for a bit.
Alex, let me ask you about Japan, another market that's hit a new all-time high. It's above 39,000 now. It last hit that on the very final day of trading back in December 1989. Where does Japan go from here?
It is more tech-driven value of this round. So this is supported by NVIDIA, and we have certain high-end manufacturers in Japan making new highs. So and I think we probably may still see Japan to go higher. Global interests are gathering, and actually many companies' fundamentals are improving. So I still like Japan, and it is relatively cheap compared to US, of course. So we probably may see momentum to continue.
And is it benefiting from also the fact that it's not China, and some of this money that's coming out of China needs somewhere else to go to?
Yeah, this is of course another reason behind this rally. But companies with exposure in China, let's just say, though, actually are not doing too much. So and also tourist arrival from China actually is remain a little bit weakish. So I think that is not helping too much. But I think in terms of fund flow, it would be continue to benefiting from the outflow from China.
David, how do you feel about Japan? It's quite a big psychological level, isn't it? Regaining that all-time high that it last hit back in 1989.
Yeah, that's pretty scary. 1989, the latest high.
Do you know that was the date that I moved out to Japan? That very day the market peaked in 1989 was the day I arrived in Japan for 3 years.
Time to move back. But it's I mean, with the yen where it is, it's relatively cheap. It's still relatively cheap for currency-wise to invest in Japan, and it is I mean, the market's been stagnant for so long, and the earnings are coming, and the economy is starting to turn around, and there is things. It took phenomenally long time for things to shift, but it's still I think the U.S. and other markets around the world have new highs. It seems every other week. A couple of years ago, we had straight momentum upwards. That didn't happen in Japan, so it's almost a catch-up play. But with the currency where it is, I think still there's a lot of room.
So you think, that we could start seeing Japan doing what the US is doing and just keep notching, and India has done as well this year, just keep notching more and more all-time highs?
I think so. I think that's in the short-term forecast, at least.
It has got the benefit of all this corporate reforms, hasn't it? It's a very different-looking Japan from 1989. There are some real shareholder reforms going on now.
Well, I guess Japan is one of those places that just takes a long time to get things right. So this corporate reform, it was overdue for ages and ages. So, and the fact is that it's going to, hopefully it feeds upon itself. That look, wow, we can actually have good governance and our stocks benefit. So I think transparency and will only benefit the market further.
Alex, got to talk about China. The CSI 300 rallied for the 9th day on Friday. It's up about 3.7% for the week, and it's turned positive for the year now. So is this sustainable?
I think it would still be going higher, but the pace actually would be quite slow. First of all, I want to point out that among the group, actually EVs and solar are very weak right now. If you look at the US solar stocks and EVs, actually, they are coming down. Things that China are doing very well, actually, are depressed right now. So actually, that is reflecting the concern on pricing power of Chinese companies. When a sector is dominated by Chinese, actually, the profit margin actually would be very because of the overcapacity situation. So I think that is the key long-term risk in investing in China. So that's why I don't think there would be too much upside eventually. But right now, I think sentiment is improving and we are seeing some catch-up buying in certain sectors. And then the good thing is that we are seeing some renewed interest in internet from outside. We have Sichuan calling buy on Baidu last week, and that is, I think, a good sign. So probably may see some strength in certain names in internet, and also Chip.com is being hot right now, and that is also happening. So I think certain sectors in China is okay, but I don't think the manufacturing sector would be the good one to pick right now.
And what do you make of all these restrictions on quantitative funds selling? We've heard reports about being banned selling at the opening and the close, although the CSRC did deny that on Friday. But nevertheless, there is a lot of scrutiny, isn't there, on these types of quantitative funds, and there are various restrictions in place. What are your thoughts about that?
Oh, I think that is bad for liquidity in the Asia market because of this concern. So we probably may see lower trading to be a trend. And then also, if people are concerned about selling, then they would not buy because they know that the risk of exiting actually would be going higher. So I think that is not a good thing for the overall market, even though in the short term probably it would be supportive. But in the long run, actually valuation would go down because of the concern on liquidity.
This must be a big concern for foreign investors, mustn't it? Because they've got duties to their clients, their customers, and if they can't sell, they can't meet those fiduciary duties.
Yeah, I think that's why I think Hong Kong actually would outperform China because of this concern. So very likely we may see more trading from foreigners to be focused in Hong Kong.
So do you think the Hang Seng's turned a corner?
I think we have seen a low. It would not be tested for some time. I think we are likely to see some more recovery. But the upside may not be too much. As I've said, I am not keen on manufacturing. And then consumer names actually may not be too high as well because of the deflation expectations. So we need to see the internet to pick up a lot, but probably Tencent would still be affected by the selling pressures from its big shareholders. So I think overall the upside potential is not that huge.
David, what are your thoughts about mainland China and Hong Kong? What sort of interest from customers there?
Well, I think in China, anytime you ban or limit trading, so just preventing short sales, I could see banning naked short sales. But if you have access to shares to borrow, short sales provide liquidity, and you have these long short funds, which actually do a good job in the market of providing liquidity and keeping things in check. Everyone goes mad when markets fall really fast, but you have to be just as careful when they rise so quickly because they tend to fall faster. So I don't think it's going to help them long term. It's a short term. It's a Hail Mary pass. So it's not great. So I think it'll use a little bit of confidence when that happens. So that'll take some time to get back. And then you got to get the housing under control, where money's going in to support developers and projects, but the reality is that it's the people in the call it the suburbs of China, which is pretty much everywhere. They need confidence in the market to feel some wealth back, and pricing has to stabilize in housing, so they feel the wealth effect, so they can go back into the market. So I think in that respect, Hong Kong will benefit and outperform because it seems more confident. It's not the greatest in Hong Kong right now, but the confidence is slowly coming back.
And it's a freer market, as you say. It's when you put all these restrictions in place, it makes people worried that they could get trapped into the market.
Absolutely. So if you have a place to invest, you're going to put your money where you can get it out.
Okay, interesting thoughts there. Well, thank you both very much for speaking with me this morning. Great to hear your thoughts on the markets. That was David Friedland, who's Managing Director for Asia Pacific at Interactive Brokers, and Alex Wong, who is Director of Alex KY Wong Asset Management. I'm joined now by Dr. Yanan Wu, who's the Chairman and CEO of Surfin Group, headquartered in Singapore. Morning, Yanan.
Good morning, Peter. How are you this morning?
I'm great, thank you very much indeed. Now, look, China markets, the CSI 300 ended 0.1% higher on Friday, but for the week, up almost 4%, so quite a significant rebound since markets reopened from the Lunar New Year holiday. And the CSI 300 has now turned positive for the year, although it is down about 40% from its peak in 2021. What is the mood, the sentiment like on the mainland among investors at the moment towards the market there?
Yes, it's really a volatile market so far in 2024 for Asia. It's, basically the confidence rebuilding mood right now. So trying to recover from the probably, the one of the ugly start of a new year. So if you look at, since last November 2023, the Asian market has been into a down mood, mostly driven by three forces. One, of course, is the confidence. The fundamentals actually hasn't changed much, but actually the confidence for the prospect economic recovery is in a very moody situation, especially the so-called northern bound capital or the foreign flows has reduced quite succeed very rapidly. So they slowly, I think, globally reallocation out of China to the nearest markets such as India or Japan. So I think the global allocation has disfavor of Chinese Asian market since the first quarter of last year. And secondly is the is the so-called margin calls, and also by security financing, and also the stock collateralization by some of the major shareholders of Asia listed companies reach a historic high. So that give further pressure to the downward trend momentum of the market. And third is the crowding effect of some of quantitative funds that's mostly biased towards small caps, and that introduce a further selling pressure, after the reallocation, sector rotation, the style rotation for the quant funds. So all these three factors, basically form a perfect storm from the end of last year to early this year in January. So, but I guess the three other positive momentum, for rebuilding the confidence. One is, of course, the national team coming in to support markets, represented by central government reserve, Huijin, funds buying the ETFs, in various sectors and styles. And secondly is the change of the CSRC leadership. The old chairman is gone and represented the new CSRC chairman, Mr. Wu Qin. And third is the talk about slow supply of IPOs, but more scrutiny of the delisting in the new year. So that create a recovery mood so far in February after Chinese New Year, the start of Year of Dragon in Asia markets.
Is there a worry on the mainland among investors that a lot of this rally is coming because of support measures from the regulatory authorities, restricting selling, telling certain funds that they can't short sell, others that they can't offload their stocks? Is there a worry that without those support measures, really, that the market would struggle to move up at all, and therefore that this may be just a temporary rebound?
Yes, we have to watch and see. So at least, so far, the mood is positive. Of course, there's some measures by the so-called window guidance from the regulators. For example, this, just basically for a short while, this force no short selling. That's number one. Secondly, there also no net selling for any fund in the opening market or closing bell of the market. So that's probably the temporary measure introduced by the regulators trying to cool down the momentum or sentiment. But I think so far, at least we can see the regulators has a rather very clear tolerance level. For example, the Shanghai Composite at 2,650, the index at that 2,650 point seems is what the regulator can tolerate the bottom of the market. So that's where the national team come in, the Huijin capital. Support market with estimates so far has been invested in various ETFs for about over 170 billion RMBs. So that shows the government trying to support the government at this, very cheap valuation level. And secondly, the new chairman, CSRC, Mr. Wu Qin, has visited the stockbrokers and also talked to some experts of the stock market and also retail investors, trying to listen their feedback and views. And the new chairman's style is very harsh on the regulations on the transparency of the listed company, and has very harsh measures toward those have cheating or have insider trading. So far, there's quite a number of cases already reviewed after the new chairman, Mr. Wu Qin, takes the post. So I guess the market is sensed that there will be slowdown of IPO supplies, because from the last 2 years, the IPO, Chinese Asian IPO has hit global historical high. It's the world's largest IPO market, while the market mood is not strong enough. And with the new chairman coming in, that's trying to slow down the supply of the IPOs, but actually would put more scrutiny on the delisting process. So we'll see more and more, probably the very questionable listed company with various issues will be delisted, exit the market. So hopefully that will give a more positive momentum and a sustainable sentiment for the capitals, whether it's from domestic or from foreign capital, to re-enter the market.
I suppose from a foreign investor's point of view, though, the problem with some of these measures is that although they help support the markets, they don't really deal with the underlying problems that are causing people to sell in the first place, which is the ongoing troubles in the property market, deflation in the economy, and so on. Are the regulators conscious of that at some point, for the market to have a sustainable rally, it probably needs some of those underlying issues to be dealt with?
As you just mentioned, the property market, whether stable or not, and also all the consumer confidence, whether it can rejuvenate after Chinese New Year's. Because we've seen that two have reached a high level, and the money supply, of course, reached the extreme. The central bank reserve, the capital reserve also reduced. So that shows the monetary policy has already done enough. Now the government has to show more, financial incentive to the economy. So reduce the tax and support the private enterprise, and rejuvenate the economic their activities. So when the capital probably see that can be turned around, hopefully at the two meetings that's coming up in the early March, in about 2 weeks' time, we'll see the People's Congress and the consultancy meetings, the so-called two meetings in early March. Hopefully we'll see some new policy really to have more incentive to support the private enterprise and also to stabilize the property market. So that part, whether the market can be sustainable, really depend on we have seen new policy to stabilize the economy and regain the consumer confidence, and also to see the manufacturing activity, the PMI, can be continue in the expansion mode.
And what about the surprise cut in the loan prime rates, the 25 basis point cut in the 5-year LPR? What sort of impact has that had on the market and on sentiment overall?
Yeah, the so-called asymmetry cut of the reserve, the LPR rate, is basically try to support the 5-year or the mortgage market, to show that the government still want to put as much as the policy incentive to let the bond to support the property market, because that's really currently the backstone for the Chinese economy. So the property market is stabilized, hopefully. Then we can see the whole economic activity can be stabilized. So that's just the sign of the asymmetry cut of the LPR rate. But besides that, the market still want to see the finance department has to show more cutting the tax and show more supporting measures for the small and medium enterprise, the private enterprise. Otherwise, the whole economic activities and also the employment rate workers back to the workforce, back to the market can be regained. So that's we still have to see in the next month or so whether the policy coming out.
Yanan, always a pleasure to talk to you. Thank you very much for your insights this morning.
Yeah, thank you, Peter.
That's Yanan Wu, who is the chairman and CEO of Surfin Group, which is headquartered in Singapore.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, chairman of the Asia CEO Forum at IMA Asia, David Roche, president and global strategist at Independent Strategy, and our US economics correspondent, writer and broadcaster Barry Woods. See you tomorrow.
Money Talk